We are tracking shares of Walmart hitting a record high, beating earnings expectations, seeing continued momentum in grocery, but also in general merchandise. And that undoes what has been something of a slump in that part of the business. And also in an unusual move, Walmart boosting its forecast for sales. Sometimes when it beats earnings expectations, it doesn't always say we expect that to continue. Now, we should put a caveat around this. The boost to sales forecast is still pretty minimal, now expecting 4.75% growth compared to their previous view of around 4%. But still, investors taking comfort. Let's bring in Arun Sundaram, who is a senior equity research analyst at CFRA. Arun, thanks so much for joining me. Am I right that it is, as I've listened to Walmart's previous conference calls, they've exercised a great degree of caution on whether their positive trends can continue. This seemed a little bit different in terms of management's view on the momentum in the business.
Yeah, hey, Amber, thanks for having me. Yeah, no, the quarter was really good. The first half of the year has been really strong for Walmart. I think many of us, including myself, expected Walmart to beat on the top and bottom line. The big question, honestly, was whether they would raise guidance this quarter, and it was encouraging to see that the guidance was raised. Although it is still a little bit short of consensus estimates, but again, Walmart is typically pretty conservative in their outlook. In the second half of the year, there is still a lot of uncertainty. It's an election here in the U.S. and that typically doesn't bode well for consumer spending. And there's also a shorter holiday season this year versus last year. So there is still a little bit of risk there. But like I said, nonetheless, it's good to see that they raised outlook, because we actually thought it would be a 50-50 chance whether they would raise the outlook or keep it unchanged this quarter.
They also made comments about back to school, and I think it's a real bellwether on how that is progressing. They said it's off to a solid start. Is that good for Walmart? Is that good for the industry?
It's great for the industry. It's great for all big box retailers. And it's also encouraging because it kind of gives us a signal of where holiday sales will be at the end of the year. So typically when we have a strong back to school, back to college season, that bodes well for Halloween, it bodes well for Thanksgiving, and it bodes well for Christmas and New Year. So encouraging to see a solid back to school season. I think next week when Target reports earnings, they'll probably see a strong result as well. They typically, for Target, back to school, back to college is typically a little bit more important for them, a bigger portion of their sales. So yeah, we'll see next week when Target reports. Yeah,
that was going to be my question. I was going to ask if this news by Walmart is good news or bad news for Target, because they don't have the same grocery exposure, and is Walmart growing at the expense of Target?
Yeah, great question. No, I think the Walmart earnings today is a positive read-through for Target's earnings next week. One reason is because Walmart's general merchandise sales seem to be improving, and general merchandise or discretionary sales, that makes up a larger portion of Target sales mix versus Walmart. For Walmart, it's predominantly a grocery retailer, like you said. For Target, grocery or food and beverage for Target is about, I think, like 20 to 25% of their sales. So we're expecting, Target this upcoming quarter to post positive comparable sales growth, which would be the first quarter of positive growth in some time now. And I think that's a big inflection point and shows that discretionary sales are not necessarily getting worse, and for some retailers it actually is getting better. Like I said, for companies like Walmart, Target, even Costco, I think is seeing really strong discretionary sales in certain categories. And it kind of shows that while consumers are being mindful and cautious on their spending, they're choosing to allocate their budget to these value retailers, to these retailers that offer convenience, and those retailers include Walmart, Costco, Amazon, and even Target.
We're really being asked to pay up for these retailers that execute, right? Costco, 50 times earnings, Walmart, 30 times earnings. Target, I get, is a little bit more of a challenge story, but it's only 15 times earnings. How do you think about valuations and whether these companies should be trading at these levels?
Yeah, no, great question. So yeah, that's we've, I think over the past few years or so, we've just seen valuation multiples continue to expand across the retail space, except maybe for Target. And that's actually one of the reasons why we have a buy rating on Target. for Target, we actually see good fundamental growth in the future, and we also see the possibility for multiple expansion for Target because I think there's a little bit of catch up for Target compared to Walmart and Costco. But yeah, you're right. In terms of valuation multiples, it has been expanding, and I think these premium multiples can hold, and the reason is being these retailers are really diversifying their business. They're not just becoming a retailer anymore. For companies like Walmart, for example, they're growing their advertising business. They're growing their third-party fulfillment services business. They're growing their data monetization business, their health and wellness business. These are high-margin service streams for these retailers, and that's really exciting because for almost like a decade or so, a lot of these retailers just didn't see that much margin expansion. But given these new revenue streams, I think over the next at least 3 to 5 years, we'll likely see solid operating margin expansion for these retailers, and I think that's why these premium multiples can hold.
I thought it was interesting. E-commerce still a huge growth area for Walmart, up 22%, approaching profitability. Is this an area of the business that could be meaningful, or do you think it will be a thin margin business?
Well, I mean, for the time being, it's going to be a thin margin business. I don't think e-commerce will ever be as profitable as in-store sales. But you have to remember, like, with the growth of e-commerce comes the growth of advertising, right? And advertising is a much higher margin business than selling goods inside of a store. So with that advertising business continue to grow, right now it's growing at like a 20-25% clip. That bodes well for the overall e-commerce business. But yeah, I mean, this quarter, I think one of the encouraging takeaways is that Walmart's e-commerce business is slowly approaching profitability. We thought that e-commerce business would approach profitability in about a year or two. So it seems like it's happening sooner than we expected. And that's a big inflection point there, and that bodes well for overall margins. At least again for the next, at least probably say next 3 to 5 years.
Do we have a sense of how much e-commerce makes of total sales?
Yeah, we do. It's so e-commerce now is about 15.6%. So about 16% of total sales is e-commerce. If you go back to prior to the pandemic, it was about 8%. So that penetration rate has doubled since the pandemic began. And now Walmart's total e-commerce business is over $100 billion. It generates over $100 billion in sales annually. So it is growing rapidly, and we think that will continue to grow, especially as it grows its e-commerce business internationally. We haven't talked about this yet, but it's growing its e-commerce business in Mexico and in Canada. It's growing in China as well, and these are fast-growing markets for Walmart's e-commerce business.
I mean, I just want to underline that number: for $100 billion in sales and still not profitable. It just goes to show you just how big Walmart is, right? That they can run this little experiment and not make money from it.
Yeah, I mean, there's not many retailers that can have a $100 billion business and not be profitable. I think that's why companies like Walmart, even Amazon. Amazon didn't make a lot of money in their e-commerce business for a long time, but you didn't really know that because it had its AWS business, its cloud business that was super profitable. So yeah, I mean, I think these retailers are advantaged given their scale and size. But yeah, I think it's encouraging to see that the e-commerce business is becoming more profitable. It's also becoming more profitable for Amazon. It's becoming more profitable for Target. I think Target is actually, has been in the lead compared to some other retailers, especially Walmart, because really early on, Target, realized that its physical footprint wasn't necessarily a disadvantage, and it used it as an advantage. And I think over 95% of Target's e-commerce sales are fulfilled from one of Target's existing stores. So very little of Target's e-commerce sales are fulfilled from a distribution center or something like that. So it's really using it. Its model is really a store as a hub model, and it's using that to fulfill e-commerce orders. And I think Walmart's doing that as well. And I think that's also a reason why some of the, like Target, Walmart, I think they have an advantage in the grocery space in terms of e-commerce because they're so close to the end consumer. I think 90% of the U.S. population lives within 10 miles of a Walmart store. That's key when you're delivering perishables like grocery to the consumer, and that's where Walmart has an advantage where Amazon may not have that advantage.
Arun